Okay, let's try and unpack
It's
this.
a lot to unpack.
It really is. If you're trying to follow the money right now, you are probably very confused because the map, it keeps changing.
Every single day.
We're living in a genuinely complex financial moment. I mean, on one hand, you have these private, totally decentralized digital coins crossing the dizzying mark of $100,000.
Driven by code and, let's be honest, a lot of speculation.
A ton of speculation. And then, on the other hand, governments are rushing to launch their own centralized digital versions of cash. They're demanding control.
And then somewhere in the middle of all that chaos, you've got what? Digital drawings selling for millions of dollars?
Exactly. The entire financial landscape has just been completely fractured and well-reformed.
It truly has.
Yeah.
And the speed of this changes, it's just unprecedented.
Yeah.
What we've put together for this deep dive is a stack of research, both foundational and current, that we hope really cuts through the noise.
Okay, so what's the plan?
We are going to synthesize the core definitions, look really closely at the global regulatory battles that are happening right now, and dissect the extreme volatility in these markets.
And maybe most importantly.
And perhaps most critically, we want to make sure you understand the huge difference between private crypto, like Bitcoin, and the government's very powerful answer to it: sovereign digital cash, the CBDC.
Right. So our mission today is pretty simple, but it's vital. We want to give you those aha moments, the context you need to feel completely well-informed.
Exactly. By the time we're done, you should have a solid grasp on the core technology blockchain, the most famous private currency Bitcoin.
The government's countermove, the CBDC, and, of course, those weirdly unique digital assets known as NFTs. So let's start at the very, very beginning, because you really can't understand this whole movement without understanding the philosophy behind it. What kicked this all off?
It all comes down to a crisis of confidence, a crisis in centralized authority.
In the government and the banks.
Precisely. At its most basic, a cryptocurrency is just a digital or virtual currency that uses blockchain technology to be secure. Bitcoin is, the original, the classic example.
But the why is the real story.
The why is the story. It's distrust in economics. The whole idea for this decentralized money came directly from a deep-seated loss of faith in traditional fiat money.
And for anyone who doesn't know, fiat money is just government-issued currency. Dollars, rupees, euros.
Exactly. And that loss of faith really exploded after the massive global trauma of the 2007 USA subprime crisis.
That crisis wasn't just a recession, was it? It felt different. It exposed these deep structural flaws in centralized banking.
It did. Suddenly, everyone saw that these massive institutions were too big to fail and needed enormous government bailouts.
Which were paid for by taxpayers.
Right. And that intervention, plus the quantitative easing that followed, it reduced the dollar's purchasing power. It signaled to a whole generation that central banks and governments weren't these perfect, infallible stewards of value.
So this was basically a rebellion.
It was a financial and ideological rebellion. It was a search for an alternative currency that couldn't be manipulated, couldn't be printed into oblivion, or controlled by one single entity.
And they wanted to get rid of the friction in the system too, right?
Oh, absolutely. The transaction charges, the slow settlement times from banks and credit card companies, they wanted to just circumvent all those intermediaries completely.
And the technology that makes that possible, the thing that allows for trust without a third party, that's the blockchain.
That is the indispensable backbone of this entire revolution. It's a secure, decentralized database. The technical term is distributed ledger technology, or DLT.
Okay, so break that down. A distributed ledger.
So, instead of a single bank owning one big ledger book, the ledger is copied and spread across thousands of computers or nodes all over the world.
So everyone has a copy.
Everyone has a copy. And its key features are what make it so revolutionary. It's a constantly growing list of transactions. Those are the blocks. Any new entry is visible to everyone on the network, so it's transparent.
And you can't change it.
You can't change it because every new block has to reference and cryptographically validate the previous block. You can't go back and alter or delete records. Once a transaction is on the chain, it's permanent. It's immutable.
So you get this radical transparency and security through distribution, not through one bank or government holding all the power. That's a huge philosophical shift.
It is. And while we always associate it with Bitcoin, the underlying tech, DLT, is, that's agnostic. You can store any kind of verifiable data on it.
Like what?
Supply chain movements, medical histories, voting results. Not just money. The potential for DLT goes way beyond finance. But its first, most explosive use case was, of course, currency.
Let's focus on that first application then, Bitcoin.
Hmm.
Who actually built this system that was designed to bypass the banks?
And that remains one of the great sort of romantic mysteries of the digital age.
Right.
Bitcoin was launched in 2009 by this anonymous person, or maybe a whole group of people, known only by the pseudonym Satoshi Nakamoto.
And we still don't know who it is.
Still no idea. But the identity is actually less important than the result. The creator intentionally just walked away. They ceded control, leaving the code to be maintained by the community.
Which is the whole point of decentralization.
It's exactly the point.
Yeah.
The individual doesn't matter, the algorithm does.
So what makes Bitcoin fundamentally different from, say, the US dollar, besides the whole decentralization thing?
Scarcity.
Hmm.
And this is absolutely vital to its entire valuation. Unlike dollars or rupees, which a central bank can just print infinitely,
Mm-hmm.
the total supply of Bitcoin is strictly limited to 21 million coins,
And that's a hard cap.
a hard cap.
Yeah.
It is immutably written into the original code. This programmed scarcity is what its supporters argue makes it a reliable hedge against the inflation that's just built into our traditional money systems.
And since we're diving into the details here, let's give our listener a foundational nugget. What's the smallest unit of a Bitcoin called?
That would be the Satoshi,
Named after the creator.
named in honor of the creator, yeah. And it represents how incredibly divisible the currency is. So just like a dollar breaks down into 100 cents, one single Bitcoin is equal to 100 million Satoshis.
So that's 10 to the power of 8 Satoshis.
Exactly. It's a crucial detail. You don't need $100,000 to buy in. You can buy a tiny, tiny fraction of a coin.
Now, Bitcoin gets all the headlines, but it's not the only player out there. It's a huge ecosystem. What are some of the other major cryptocurrencies we're tracking?
Well, first and foremost is Ethereum. People often talk about it just like another cryptocurrency, but its real importance is its ability to run smart contracts.
The TAR?
They're self-executing contracts, where the terms of the agreement are written directly into the code. That functionality makes Ethereum the backbone of the whole decentralized finance or DeFi movement.
Okay, so it's more of a platform.
It's much more a platform.
Yeah.
Then you have things like Litecoin, which is often called the silver to Bitcoin's gold because it has faster transaction times. And then increasingly you have coins like Dogecoin,
The meme coins.
the meme coins. Yeah. They fall squarely into that category, defined more by internet culture than by any real technical significance.
That gives us a really great foundation. So now let's move on to how we categorize all of this, because the term digital money covers this huge spectrum. You've got government projects on one side and, Dogecoin on the other.
We have to draw a really sharp, clean line here. There are two major categories of digital currency, and it's all based on who issues them.
Okay,
We are talking about sovereign and private digital currency.
let's start with the government side, the centralized approach.
So the sovereign or government-issued category is, well, it's issued directly by a nation's government or its central bank.
Yeah.
The prime example we're focusing on is the Cbdc, the central bank digital currency.
Like the digital rupee that you...
Exactly, like the euro. The key takeaway, the most important thing to remember, is that this is centralized digital currency. It's backed by the full faith and credit of the state, just like physical cash. It represents authority and control.
And then you have the entire universe on the other side, the private digital currencies, representing freedom and decentralization.
Exactly. The private or decentralized category is vast.
Yeah.
It's everything not issued by a state.
And that includes the serious projects?
It includes the standard cryptos, yeah, the ones with real technical utility, like Bitcoin. But it also includes that newer phenomenon we mentioned, the humorous coins or meme coins.
Right. Their names are often inspired by animals, characters, cultural moments.
Dogecoin, celebrity coins, you name it. Their value is driven almost entirely by social media hype and speculative frenzies, not by any kind of inherent utility or scarcity.
So whether you own a serious Bitcoin or a whimsical meme coin, you need a safe place to keep it. The idea of a digital wallet can be confusing for people new to this. How do you store these things securely?
You absolutely need a crypto wallet, but the security level depends completely on its connectivity to the internet.
Okay.
We really talk about two main types, and it's just based on whether they're online or offline. We call them hot wallets and cold wallets.
So what's the practical difference in terms of security?
A hot wallet is any wallet that's connected to the internet. So an online app, an account on a major exchange like Coinbase, software on your phone,
The convenient option.
immensely convenient for quick trading and transfers. But because it's online 24/7, it is inherently the most vulnerable target for hackers, for phishing scams, for any kind of cyber attack.
So the trade-off is speed versus safety. What about the cold wallet?
That is the gold standard for security, especially if you have large holdings. A cold wallet is a piece of hardware. It often looks like a special USB drive or a little calculator-like device.
And the key is it's not connected.
The key is it's fundamentally not connected to the internet. You only plug it into a computer when you need to make a transaction, and then you unplug it immediately. This physical disconnection just removes the vast majority of online attack vectors. So much more secure.
So if you're serious about this, a cold wallet is almost mandatory.
I would say it is, yes.
That storage distinction is foundational knowledge. Now let's turn to that other major digital asset we mentioned, the one that famously sold a JPEG for $70 million. Non-fungible tokens, or NFTs.
And this is where we need to make another critical distinction. The source material is very clear on this point. NFTs are not money.
Why not?
Because they are fundamentally different from Bitcoin or a digital rupee. They have the property of being non-fungible.
So why does non-fungibility matter when we're talking about finance?
Because finance and money itself relies on interchangeability. Fungibility just means that the units are perfectly interchangeable.
Like a dollar bill.
Like a dollar bill or a unit of gold. If I trade you 1 ounce of gold for another ounce of gold, the value is identical. They can circulate as currency. An NFT, however, represents a unique, one-of-a-kind asset.
A specific digital painting. A specific ticket to an event.
Exactly. You can't just exchange one NFT for another and assume they have the same value, even if they're from the same artist. That uniqueness is what makes it a collectible asset, and it's what prevents it from ever functioning as a stable circulating currency.
That makes perfect sense. The value is totally subjective based on scarcity and its unique history, not on any underlying monetary utility.
Right. And that subjective, unique value is what sets the stage for the dramatic, incredibly volatile markets we've seen recently. Which brings us to the realities of actually trading in this asset class. And the single defining characteristic of private crypto markets is extreme, often brutal, volatility.
If you were following the news a couple of years ago, you definitely heard the term crypto winter. It sounded catastrophic.
The crypto winter, which was roughly 2021 through 2022, was a major market correction. And it was a devastating period for speculators.
How bad was it?
Bitcoin prices fell about 70%. It went from a peak near $70,000 all the way down to around $20,000. And it stayed down there for a long time.
So this wasn't just a little dip.
No, this is a brutal wake-up call. It showed the very real risk involved when assets aren't backed by any kind of sovereign guarantee. Investors learned the hard way that high returns come with the potential for massive, even total, capital loss.
And yet since then, the market has shown this incredible, almost defiant resilience and growth.
That's the nature of these cycles. The 2024-2025 boom saw prices recover in a big way, with Bitcoin even crossing that huge psychological mark of $100,000.
What drove that recovery?
Well, the sources attribute it in part to shifting regulatory winds and a lot of political speculation. Market sentiment really improved based on the anticipation that certain high-profile pro-crypto figures, the notes mentioned Donald Trump, or powerful influencers like Elon Musk, would push for more relaxed regulations and lower taxes.
Making it easier for big money to come in.
Exactly, making the investment environment much more favorable and accessible to larger pools of capital.
So volatility is driven by these external factors, but Bitcoin has this fascinating internal mechanism that's designed to control its own supply and kind of bake in scarcity. The Bitcoin halving.
The Bitcoin halving is absolutely fundamental to its scarcity model. It's arguably the most important scheduled event in all of crypto economics.
And it happens automatically.
It's coded to happen approximately every 4 years. So what happens is the reward that's paid in new Bitcoin to the miners, the people using computing power to validate all the transactions, that reward is automatically cut in half.
By 50%.
By 50%.
Yeah.
And this deliberate action drastically slows down the rate at which new Bitcoins can be created and enter the circulating supply.
Which means?
It acts as a mechanical supply shock. By controlling the rate of new supply, it reinforces that hard cap of 21 million coins and acts as a powerful brake against any kind of inflation within the coin itself.
So it's designed to be deflationary.
That's the argument. It's a key reason why Bitcoin is framed not just as a currency, but as a potential deflationary store of value, which is in sharp contrast to traditional fiat money.
That built-in scarcity is brilliant, but we have to confront the real-world dangers here. I mean, even the best decentralized tech is often managed by centralized human organizations. And that's where the failures and the outright fraud seem to happen.
Oh, absolutely. The dangers were often concentrated right around those centralized exchanges. The sources highlight two essential examples you should know as concrete symbols of this systemic risk. First, FTX,
That was a huge collapse.
one of the largest global exchanges. Its spectacular collapse led to the arrest of its CEO. The key problem, to simplify it, was that there was no separation between customer funds and the exchange's own trading arm.
So they were playing with their customers' money.
They were. So when their trading arm failed, the money of over 1 million investors was just stuck
Yeah.
or lost because the reserves simply weren't there. It's a powerful lesson in the risk of trusting an unregulated third party with your private keys.
And the second example shows that even regional players are vulnerable.
Exactly. WazirX, which is an Indian portal, suffered huge financial losses from a major cyber attack. The risk here wasn't internal fraud, but external security breaches.
So we don't need to get bogged down in the technical details of the hack.
No, the takeaway for you has to be remembering these names, FTX, WazirX, as symbols of the massive inherent ecosystem risk: fraud, mismanagement, and centralized cyber vulnerability.
These failures and the constant use of crypto for illicit activities mean that governments are now sitting on a massive pile of seized digital assets. And the U.S. in particular is trying to figure out how to manage this stockpile.
This is a fascinating intersection of crime and high finance. There's a proposed initiative for a USA Bitcoin strategic reserve, expected around 2025.
And what would that do?
Its purpose is purely pragmatic: to manage and monetize the estimated 200,000 bitcoins that federal agencies have seized from criminals, from cyber syndicates, from dark web markets.
Wow, 200,000 bitcoins at recent prices. That's a staggering amount of money.
It is. It's a huge financial resource. And the proposals for this strategic reserve suggest several significant uses. The government could methodically sell the crypto over time for profit,
And use that money for what?
to fund public welfare programs, or even use the proceeds to cover fiscal debt without having to raise standard taxes on citizens.
So it's essentially transforming criminal gains into a public benefit.
It's turning a negative into a resource. Exactly. And this kind of government intervention is, well, it's fully justified when you look at the fundamental dangers that come with acquiring and using Bitcoin, where that lack of traceability so often intersects with illegal activity.
Our sources break down how you can get Bitcoin into 3 distinct paths, and it's really important to understand the specific risks for each one. Let's start with the first, digital mining.
Digital mining involves using these vast arrays of powerful, specialized computers to solve complex puzzles that validate the transactions. The danger here is primarily environmental and infrastructural, and it is severe.
The energy consumption.
The extremely high electricity consumption and waste. In many places, this relies on dirty energy, so you get pollution from diesel generators. The constant need for new, better hardware creates a mountain of specialized e-waste.
And it affects consumers, too.
It does. In peak demand times, the massive need for components has caused huge shortages of things like graphics cards for everyday people. It is, by definition, an unsustainable resource drain at a massive scale.
Okay, the second path is getting it as payment for goods or services.
If you're selling goods or services for Bitcoin, the danger shifts to criminality. Because the transactions are pseudo-anonymous and borderless, this method is systematically exploited for use in fraud, the narco trade, terror finance, and most frequently large-scale tax evasion.
So it's a way for dark money to move around the globe.
It's a clean, fast mechanism for it, bypassing all the traditional financial controls.
And the third path, which is the entry point for most everyday investors, is just buying it with standard currency.
If you buy with fiat money on an exchange, you face that primary danger of extreme price volatility, the risk of losing almost all your money like we saw in the crypto winter. But even here, you're still indirectly exposed to the systemic risks of terror finance, tax evasion, and fraud that plague the whole ecosystem.
And it's that combination investor loss plus illicit use that forces governments to regulate.
It necessitates the heavy hand of global regulation, yes.
This regulatory push has been particularly complex in a huge market like India, where the central bank initially just tried to block it entirely.
Yeah.
Walk us through India's regulatory journey. It's been a real push and pull.
It has been a classic battle between monetary authority and individual liberty. So step one. The journey began with the Reserve Bank of India, the RBI, being deeply skeptical, actually outright hostile.
They just banned it.
They banned all banks and other financial companies from having anything to do with crypto transactions, saying it was just too dangerous. That was the initial declaration of war.
But the courts didn't agree with that approach.
No, the ban didn't stand. Step 2. The Supreme Court intervened and struck down the RBI's comprehensive ban
On what grounds?
on the constitutional grounds of the fundamental right to carry on a business or profession. So the banking system was legally forced to interact with crypto again, which acknowledged its status as a tradable asset.
So once it was clear they couldn't outlaw it, the government's move was to regulate it and, more importantly, tax it heavily.
Precisely. Step 3 came with the budget in 2022. The government introduced a massive, signaling 30% tax on profits from any virtual digital asset, which includes crypto.
That sends a pretty clear message.
It had a dual effect. Taxing it gave it enough legitimacy to be treated as an asset class, but the extremely high tax rate was a clear signal of caution and discouraged short-term speculative trading.
And this was all happening at the same time they were planning their own digital currency.
Exactly. This tax was announced alongside the plan to regulate private crypto and to launch their own sovereign currency, the Cbdc or e-rupee.
And the government's official economic assessment of the market was pretty blunt about the risks of manipulation.
Oh, the Economic Survey 2023 made some very frank observations. It specifically noted that crypto holdings were heavily concentrated among a few powerful investors, often called whales, who have the capital to manipulate prices and drive these wild market swings.
So it just reiterated all the problems?
It reiterated all of them: high electricity use, tax evasion, fraud. And the big conclusion from this official government analysis was the need for a coordinated international effort.
Through bodies like the G20.
Through the OECD, the G20, yes, to effectively regulate this borderless asset. National laws by themselves are just not enough.
That need for international coordination shows this is a global policy crisis. So how has the rest of the world responded, from outright bans to totally embracing it?
You really see the entire spectrum. At the most restrictive end, crypto is just outright illegal, often due to strict monetary or religious rules. You see that in countries like Nepal, Algeria, Egypt, Morocco, Turkey, and Iran.
And then you have restrictions.
Right, like in China, where they haven't banned owning it, but they've prohibited banks from offering any related services, which effectively kills the domestic ecosystem.
And then on the complete opposite side, you have nations that have embraced crypto as an official sovereign currency, which is a huge political statement.
This is where private crypto breaks into state affairs. Venezuela launched its own sovereign crypto, the Petro, though its success is debatable. The Marshall Islands launched sovereign to be used alongside the U.S. dollar.
But the big one was El Salvador.
The landmark case that shocked central banks everywhere was El Salvador. It became the first nation to allow Bitcoin itself, the private decentralized currency, as legal tender right alongside the U.S. dollar. That was seen as a major philosophical victory for the whole DeFi movement.
So beyond individual national laws, these global organizations are now creating regulatory frameworks to manage these assets across borders.
Yes, and there are two major global frameworks you should know about. The EU established MiCA, the Markets in Crypto Assets Regulation.
What does that do?
MiCA is basically a comprehensive rulebook designed to protect investors and combat illicit finance across the entire European bloc.
And it covers everything.
An important nuance is that MiCA specifically does not regulate CBDCs or NFTs. They fall under separate legal umbrellas, reflecting their very different legal nature.
And what about the huge problem of tax evasion across borders?
For that, you have the OECD's CRRF, the Crypto Asset Reporting Framework. This is a global information sharing standard focused specifically on combating tax evasion. It requires service providers to report transactions, making it much harder for wealth to hide on these decentralized ledgers.
Now, over in the United States, they're proposing specific laws to deal with the nuances of these assets, especially this complex category called stablecoins. So what are stablecoins and why do they need their own special legislation?
Stablecoins are a kind of bridge technology. They're cryptocurrencies whose value is designed to be pegged to and backed by a reserve asset.
Like the U.S. dollar.
Usually a fiat currency like the U.S. dollar, or sometimes a commodity like gold. You've probably heard of Tether, or the rebranded version of Facebook's Libra project. The whole point is to get the speed and efficiency of crypto, but without the dramatic, destabilizing volatility.
But they still have problems.
Oh yeah, they still face huge regulatory scrutiny over the security of their reserves, money laundering, and fraud, which is why they need targeted legislation.
And what are the U.S. proposals trying to do in this market?
Well, the proposed laws show you how detailed the policymakers are getting. The Clarity Act is for general crypto regulation. The Genius Act is specifically to regulate stablecoins, setting rules for their reserves. But maybe the most politically charged piece of legislation is the Anti-CBDC Surveillance State Act.
That is a very provocative name. It suggests an immediate fear of government overreach.
It's designed to preemptively stop any future U.S. CBDC from having features that could enable mass citizen surveillance or control.
So it's addressing that core fear.
It addresses the major fear among privacy advocates that a centralized digital currency could give the government unprecedented insight or even veto power over every single transaction a citizen makes. And this theme of surveillance and identity is key to the whole debate.
Speaking of digital identity and control, we have to talk about one of the most controversial private projects out there right now, WorldCoin from Sam Altman. It feels part utopian, part dystopian.
The WorldCoin project perfectly embodies that tension between digital efficiency and personal privacy. The idea is to create a globally verifiable digital identity, a proof of personhood, in an age full of sophisticated AI bots.
And how do they do that?
The process involves a person physically scanning their iris, their unique biometric identifier, using a special device called an orb machine.
You scan your eyeball.
You scan your eyeball. That scan creates a unique ID, which is then stored on the blockchain. And in return for giving up this biometric data, you get free WorldCoin cryptocurrency.
And the upside is a kind of global digital passport.
That's the selling point. A global Aadhaar that could prove you're human online and maybe facilitate universal basic income.
But voluntarily giving up that kind of sensitive biometric data, that raises huge red flags.
The privacy concerns are enormous. You're giving up your unique iris scan to a private company for storage on a distributed ledger. It raises all these serious unresolved questions about data security and the potential misuse of that fundamental identifying information for tracking or control.
And it's all these issues, private crypto volatility, fraud, the environmental cost, and these growing surveillance fears around digital identity that have pushed governments toward their own controlled solution, the CBDC.
Let's really contextualize the CBDC vision. I mean, why is the central bank creating its own digital currency when we already have digital payments?
The core motivations are efficiency, control, and resilience. The CBDC, or e-rupee in India, is a digital alternative designed to solve the very real logistical and fiscal problems that come with physical cash.
Like what?
The high cost of printing, the difficulty and risk of storing and transporting billions of notes, the persistent problem of counterfeiting, and the difficulty of tracking government subsidies to make sure they actually reach the right person.
And this isn't just theory anymore, is it? This is happening now. Who are the global pioneers?
The Bahamas is often cited as the first, launching its sand dollar back in 2020. And shortly after that, Nigeria launched the e-Naira in 2021. So CBDCs are already operational, especially in developing economies.
Turning to India, what's the legal backing for the e-euro, the digital rupee?
India's digital rupee uses the symbol EU. Its fundamental nature is that of a digital token that represents legal tender. And crucially, it is not a bank deposit. It's more like certified electronic cash.
And it's legally sound.
It was created under the RBI Act of 1934, which was specifically amended in 2022 to allow for digital currency. This legal grounding is vital. Just like physical cash, the euro is a direct liability on the RBI's balance sheet. It's the sovereign's promise of value, which is something no private crypto can claim. And the RBI has been very methodical, running different trials for different uses.
Exactly. They're carefully experimenting with two formats. There's CBDC retail, e-euro, which is designed for everyday use, mimicking cash for person-to-person and person-to-merchant transactions. This is the version that could one day replace the notes in your wallet.
And the other one.
Then there's CBDC wholesale, EUROW, which is for high-value financial system use, like interbank borrowing, trading government securities, and streamlining complex cross-border payments between big institutions.
Let's talk about how the euro actually functions compared to the money in a bank account. For instance, does this new digital cash earn interest?
This is a crucial design choice, and the answer is an emphatic no. It does not earn any interest.
Why not?
It's explicitly designed to mimic physical cash. If you keep cash in your wallet, it's safe, but it doesn't grow. Similarly, if you want to earn interest on your e-euro, you have to convert it into a regular commercial bank deposit.
So it doesn't compete with commercial banks.
It complements the system rather than draining deposits out of it.
Another key property, which is a huge advantage for businesses, is transaction finality.
This is a significant improvement. The EO offers settlement finality. Unlike a credit card chargeback or a canceled check, Once a CBDC transaction is executed, it cannot be reversed or canceled.
Just like handing someone a physical note.
Exactly. The settlement is immediate and irreversible, which eliminates a lot of risk in transactions.
Okay, let's circle back to that surveillance fear. If the CBDC is meant to replace physical cash, does it offer the same level of privacy and anonymity?
As of right now, August 2024, the answer is that the CBDC is not truly anonymous yet.
Why?
Well, physical cash transactions are anonymous by nature. There's no digital trace. But CBDC transactions have to leave a digital trail for verification and anti-money laundering purposes. To get to 100% cash-like anonymity, it would require a major policy change, a new law, or a specific technology to permanently delete the transaction records.
So that's still just a proposal, not a reality.
It's a proposal, yes.
Let's get into the advanced features, specifically programmability. This is where the CBDC shows capabilities that no other form of money has. It really changes the relationship between money and the user.
Programmability is the CBDC's superpower. It allows for conditional payments. It means the digital money itself can be embedded with rules or constraints about how, when, or where it can be spent.
Give us the specific, practical examples from the source material. They show both the utility and the potential for control.
There are two great examples. First, a government could give you a transportation allowance in EO that is programmed to be used only for buying railway tickets. It guarantees the funds are used for their intended purpose.
And the second example?
A university could issue a student stipend that is programmed to expire if it's not used to buy books within 1 month. If it's unused, the money just reverts back to the university.
So it eliminates misuse.
It ensures unprecedented targeting and eliminates misuse of public or corporate funds. Beyond programmability, what are the big picture benefits for a government adopting a CBDC?
They're substantial. A massive reduction in the cost of printing and transporting physical currency. It's much harder to counterfeit, and you get hugely improved traceability, which helps with corruption and tax evasion.
It lets governments monitor where subsidies are going precisely. And for international finance, it could lead to faster, cheaper global money transfers, maybe reducing dependence on the US dollar or the SWIFT network. Before we move on, we have to clear up a common point of confusion, especially in India. The difference between e-rupee and e-rupee. They sound the same, but they are legally miles apart.
This distinction is crucial. E-rupee is the CBDC issued by the RBI. It is sovereign currency, it is legal tender, it's the electronic equivalent of cash.
And e-rupee.
E-rupee is totally different. It's not money at all. It's a specialized digital gift card or SMS voucher developed by MPCI. It is not legal tender, it's just a prepaid tool used to redeem a specific benefit, often used for government welfare schemes.
Finally, what are the big structural challenges facing CBDCs, and what are the recent updates on usability?
The challenges are significant. There's the digital divide. Many citizens lack the gadgets, connectivity, or digital literacy to use it. There are massive security concerns. A centralized national financial system is a prime target for cyber terrorism or could be paralyzed by power failures. And ironically, an environmental cost.
And an environmental cost, yes. Maintaining that secure IT infrastructure 24/7 requires a substantial, continuous amount of electricity.
What about the recent good news on usability?
Two major steps forward. In September 2023, the RBI allowed interoperability with UPI. This is huge. It means a CBDC wallet app can now scan a regular UPI QR code to make a payment.
So it taps into the existing system.
It leverages the massive existing payment ecosystem. And in April 2024, they expanded access by allowing non-bank entities like PhonePe or Amazon Pay to offer CBDC wallets, increasing competition and access beyond just the traditional banks.
We mentioned fungibility earlier, but we need to resolve that paradox we raised. If the E is programmable, how can the central bank guarantee it's still fungible and therefore still like cash?
Let's clarify fungibility one last time.
Yeah.
It's the property where individual units are perfectly interchangeable. Non-fungible assets, a specific house, a share in a company, and NFT are unique.
So the paradox is, if you program EU to only buy books, doesn't that make it non-fungible? It seems like it must, because that specific token can't be used for pizza, while a regular one can.
This is a brilliant nuance that the RBI governor actually clarified. The answer is a definitive noter. No. The EUR remains fungible at its core.
How?
The restriction is only a specific use binding on the very first transaction by the initial recipient.
So what happens after that first transaction?
Take the student who has the programmed e-euro for books. They spend it at the bookstore. Once that money passes through the bookstore system and the payment settles, the restriction is automatically lifted.
Oh, okay.
The money the bookstore owner receives is now just standard unrestricted euro.
Yeah.
That owner can then use it to pay salaries, buy inventory, or order a pizza.
So the money's fundamental nature as a rupee is preserved.
Exactly. The restriction is on the user, not on the currency itself forever. It remains interchangeable with any other euro token in the open market, so it maintains its fungibility. And that distinction is what separates the sovereign CBDC from the truly non-fungible digital assets we now need to talk about, NFTs.
So how do we define these unique digital properties that commanded such hysterical prices a few years ago?
An NFT is basically a digital file hash, a JPEG, a GIF, an MP3, whose ownership is stored and verified on the blockchain. This ownership record can also represent physical things, like the deed to a house. The key is that the value is entirely subjective. One digital painting is not equal to another,
They aren't currency because they're unique.
and therefore not interchangeable.
Exactly.
And this subjective value led to complete market hysteria.
Total market froth. The sources highlight the most dramatic examples. Beeple's digital painting, which sold for a mind-boggling $70 million. And even a piece of digital art created by robot Sophia sold for over $600,000.
So it's clear the value is driven by provenance and scarcity, not utility as money.
Right.
So beyond making a few digital artists incredibly rich, what are the practical real-world benefits of NFTs?
There are three main functional attractions. First, they make it much easier for creators to trade and directly monetize their work with verifiable scarcity. Second, they provide a clear, permanent, verifiable record of ownership, which is great for preventing digital plagiarism.
The third.
They have huge potential for paperless administration. Think of secure, verifiable digital tickets for events or digital proof of ownership for real-world assets like property.
And on the flip side, what are the primary challenges with the NFT market? Just like private crypto, there are significant risks. The obvious one is the investment bubble. We saw prices rise with mass hysteria, and then they collapsed just as quickly, leading to massive investor losses.
And they're used for illicit purposes.
They're used for illicit use, often as vehicles for high-value money laundering. And critically, because their ownership is secured by the power-intensive blockchain, they contribute directly to that high environmental impact from all the electricity consumption.
We have covered an enormous amount of ground today. We've gone from the anonymous invention of Bitcoin, which was driven by a deep distrust of the state,
All the way to the sovereign invention of the U, which is driven by the state's desire for efficiency and control, and everything in between.
but the tension we've analyzed really is the core dynamic of the financial world right now, isn't it? It's this decentralized power of private crypto, which offers freedom, but also chaos and fraud.
Versus the centralized utility and control offered by the CBDC, which offers efficiency but risks surveillance. And then you have these unique non-money digital assets like NFTs, kind of mediating between them.
What's fascinating is that the global trend is clearly toward managing and taxing these systems, not ignoring them. We saw the revolutionary freedom of Bitcoin, but that has necessarily required governments to create these crucial safeguard measures.
From the EU's comprehensive MiCA regulation to the OECD's CRF for tax evasion and India's explicit 30% tax.
That coordinated approach to regulation is the essential takeaway, I think. The technology is here to stay, but the rules are still being written in real time, often driven by the ethical and environmental costs.
We've laid out the extreme environmental cost of maintaining both private crypto mining and the infrastructure for a sovereign CBDC 24/7. And we know that CBDC anonymity is, for now, limited, so that digital convenience comes with the necessary trade-off in privacy.
So this is the provocative thought we want to leave you with. It's something that really defines the future of digital finance.
Given the significant environmental cost of maintaining both of these systems and the current limits on CBDC anonymity, how do you personally weigh the cost of digital convenience and universal traceability against the fundamental guaranteed privacy of traditional physical cash?
It's a choice, really, between efficiency and absolute anonymity. And it's a choice we're all going to have to make in the coming digital future.